The early data is in, and the market is starting the year very hot. We are looking to prepare for bidding wars, big cash offers, over asking sales, like transactions happening. But there are some opportunities in the crazy market that get created. We'll explore all of these factors today. At the same time, we've had dramatic moves in mortgage rates and inflation. So these macro factors could have big impact on homebuyer demand this year. So will they finally put the brakes on? It's been such a crazy hot market, and we're always on the lookout for the things that might turn the corner. I'm Mike Simonson, and this is the January 2022 webinar for Altos Research. Each week, Altos tracks every home for sale in the country, all the pricing, all the supply and demand. We analyze all that data and we make it available to you before you see it in the traditional data channels. We've been doing this full webinar monthly to do the deep dive. And by the way, if you haven't already seen our new podcast, I invite you to check that out. It's called Top of Mind. It is available on all the podcast channels as well as our YouTube channel. It's where we're going beyond the data. So we spend a lot of time at Altos in the data, looking at the deep data every week. But in the Top of Mind podcast is where I'm interviewing the thinkers and leaders in the industry to get their perspective on what's happening in the market, strategies for success, what we're seeing locally, as well as technology and other changes, big trends happening. So that's been a lot of fun. First two episodes are out. Find the Top of Mind podcast wherever you listen to your podcasts or on the Altos YouTube channel. So we've got a bunch of things to cover today. A little bit of housekeeping before I dive in. As usual, we have Jeff and Lael from the Altos team in attendance with us. They will be in the chat. So if you have questions along the way, drop it in the chat, and those guys will try to reply to the questions as quickly as possible as we go right through the webinar. We will try to do about 50 minutes today, looking at a lot of data, and then finish up with some of the local markets. This video is recorded for all attendees. We'll get an email follow-up at the end of this afternoon, as well as you can always go to the Altos YouTube channel and get recordings there, as well as our weekly videos and now the podcast. So make sure you go to Altos Research at YouTube, subscribe there so you'd never miss anything. So let's look at the big ideas for today. So it's early January, and the signs are the market is already looking nearly as hot as it was last year. We're going to look at a bunch of demand indicators, some of the supply indicators, some of the pricing indicators, and really see where things are shaping up. The two big macro factors they're really significant right now, both interest rates, mortgage rates are climbing, as well as high inflation. What does that mean for buyers? What does that mean for inventory and how demand shapes up for the rest of the year? We're going to try to take a look at that. Investor demand has been a big theme, both at the institutional level this year. So the big billion-dollar funds buying homes, especially single-family homes for rental, but it's also a factor of individual investors, single homeowners that own 1 to 4 units, or they buy the next home and they keep the first one as an investment property. What does that do for supply and for competition for buying new homes, as well as does that change, and is that a risk that we face to the smoking hot market right now? I think one of the big reasons that we do this webinar each month, is because home buyers and sellers are afraid. Everybody wants to know what's happening. the market is changing quickly. It's super hot, but there are some real risks in front of us. Some of our buyers and sellers see those risks more directly. Some of them haven't seen them at all yet. Everybody wants to know what's going on. So what we're trying to do is be right on top of the data, help you communicate with your buyers and sellers, use the data, use your local data to help them understand, help them make decisions, help them take action quickly. And then we're going to finish up the day with our local trends like we do. We have a few local markets to look at. Okay, I'm going to start today with mortgage rates. The biggest factor, one of the most fascinating factors happening is that this week, mortgage rates jumped to about 3.5%. That's the 30-year fixed rate. You can see in this chart, it's the far right side there. There's the little dark line that spiked up this week. Big spike, and we're at the highest mortgage rate in over 2 years now. So this is a question. And when we publish our data, the most common question we get is what happens to the market when rates rise? A lot of folks who pay attention are expecting rates to rise this year. This is both a function of the really smoking hot economy and the Federal Reserve is stopping their process of buying the bonds that keeps mortgage rates low. And as that declines, mortgage rates increase. So we've already seen a spike. And the question is, does it spike from here? Does it taper back down? And when does it become impactful? A couple things to keep in mind. One is at 3.5%, mortgage rates are still ultra low. They're essentially as low as they've ever been outside of the last 2 years, 24 months. Historically, very low. Still, the last 10 years, the average rate on a 30-year loan in the last decade has been 3.9%. So we're still below that. And it's unclear when buyers start to really feel that. As rates climb, our perceptions of affordability are impacted. Rates, in fact, mortgage rates are much more impactful to my monthly payment than the actual purchase price of my house. Much more sensitive to a small move in the rate than actually these big moves that we've had in home prices. So the question is, when do home buyers and sellers feel that change? In this chart, I wanted to start with this chart here today because you can see this, there's a little the orange line that peaks in 2018. In 2018, we had mortgage rates rising all year long. They peaked at 4.9% in early December before they started their 3-year decline, 2.5-year decline. And we can absolutely see in the data impact of rising rates in 2018 and we see the hangover in 2019. So I'm going to show you that today. So keep in mind, like that rates rose there in 2018, and we could see the impact on the market. I'll show you where that is so you can use that to help forecast your own changes, your expectations for this year. A couple things to note though. That rate in 2018 rose, you can see it rose above the long-term average. So our spike right now is still below the long-term average. Our spike is higher than it has been, but it's not higher than it has been over the long term. So the question is, do consumers feel that yet? I actually have a quick poll that I want to start with today. I'm going to start with affordability pressure. So my question to you is, when you're working with home buyers, in your experience with home buyers, we've had rising home prices, and now we have a little bit of rising mortgage rates. And my question to you is, when do you think your buyers are going to feel affordability pressures? Some of them feel it now because home prices have gone way up. Some of them may be more sensitive as rates climb. And we're just going to get a feel for the audience. Um, affordability as a predictor for home price adjustments down in the future is something to pay attention to. So if we get out of affordability and then rates spike way up, that could put the brakes on our market. I'm going to let a few more folks vote, and then we're going to share the results and see what it looks like. Okay. This is really great. So when do we expect our buyers to feel affordability pressures? All right, end this poll right now and share the results. So a third of us realize that, home buyers feel it right now. Like, home prices have been up. People feel affordability pressure. What's interesting is we've just spiked to 3.5%. And most of us are thinking that that's not really a threshold of affordability. But once rates climb above 4, we expect we're going to see it again. Some of us think it might be above 4.5%, like it took 2018 to get over 4.5 to 4.9% before we really felt it in the market. I don't have an answer to this. Rates have been so low for so long. We're just going to watch it each week and see if we can correlate as rates rise. Do some of our demand measures start ticking back? And then we report it right here. So stay tuned right here. That's an interesting report. So 4% would be maybe the next threshold to keep our eye on. So that peak in 2018, we're going to look at that, and we're going to see the impact in other charts as we go through. Let's look at inventory. Current levels of inventory are at our new record low. There's only 292,000 single-family homes active, available on the market right now. That's because we've been buying everything. We've been turning so many homes into investment properties. Over the years, you can see each year, the January starts lower and lower. And that's because each year, more of the single family homes that were in resale have been turned into investment properties, whether we're individuals who own a second home. We buy our new one and we keep the first one for investment, or from some of the funds, the institutional money. Both of those things are happening. In fact, there's far more individuals as investors than there are the big institutions, but they're both happening, and they've been happening a ton because as rates are low, it's a really good deal to own that second house, to pay those 2 mortgages, have income on one. What we noticed, and so here's the first place I want you to pay attention to, that 2018 rate spike. So through 2018, the rates climbed, and you could see that fewer people by the beginning of 2019, fewer people were holding on to that second home to buy the next one. They were selling it. And so inventory rose a little bit. You can see from 775,000 at the beginning of 2018 to 817 at the beginning of 2019. And every other year, inventory falls every year. But in that rising rate year, that's what we had difference. So you could feel it in the market. You could feel the slowdown at that time. It took longer to sell. You could see all of the factors. But what's notable is it's not a crash. It's a little bit more. It's a little bit more opportunity, for example, for first-time home buyers, maybe less competition. We thought we were going to see some of this last fall, a little bit cooling last fall, but it's turned around and kicked back in super strong again. So as of right now, all the signals are red hot. So we're at a new record low right now. The question is, does inventory keep falling through, like it did last year, through the end of April? Normally, inventory bounces around for a few weeks here in January, February, and then starts climbing up. So in normal years, it starts climbing up in February, March, April. But last year, it's kept going low, and we didn't hit our bottom until April 30th. So unclear whether which pattern we're on. If we look at the forecast, here's one way to look at what's going to happen with inventory this year. Each line on this chart is a year. So you can see the curve. The normal curve dips a little bit in January and February, picks up in April, May, June, July, peak in July, and then starts curving back down. The 2020 pandemic year, rates cratered, super cheap, and lockdown. And so inventory, we just gobbled up everything. Last year, we had a more normal curve of the year, but it shifted way lower. This year, the dotted line is what would happen to inventory if it followed the more normal curve, meaning inventory starts climbing in March and April, and then tapers off again at the end of the year. So we're starting low. And so we could, if we followed our typical year, we could end the year at 225,000 homes. Now, this is absent a big spike in rates. So there's a dark line here at the top, the 2018 line. As rates rose, you could see 2018 started lower than most, and you can see it through the year. Rates were rising, the market was cooling, and more inventory was building. So that little fraction, a few tens of thousands of homes, were available. And so you could imagine our dotted line, if rates climb this year, to move up a little bit like that. Maybe we're in our 300 or 350,000 range instead of our 250,000 range. So there are no signs in the market of a spike in inventory, of a surge in inventory. There's a lot of new construction that isn't complete yet, and so that'll come to market. But in our existing, there's really no sign of any surge in available inventory. So slightly more is the best we're looking for. And here's one of the reasons. So we're almost done being able to talk about the mortgage forbearance process. We are, as of last week, the mortgage delinquencies it's the November numbers now that are reported. Mortgage delinquencies are at 3.8% of mortgages are in any stage of delinquency. 3.6 is the record low. So almost record few homes are in any stage of delinquency. That means that, and this is falling every month. So that in a few months, probably by April, we're going to be at record few homes in any stage of delinquency. That's because the economy's hot, mortgages are cheap, everybody has a good mortgage, the payments are low, and so it is really a good time to hold on to your home, and a really lousy time to go to stop paying your mortgage. So because we have record few homes in any stage of delinquency, there's no surge of distressed properties that is even possible to hit the market. So there's no inventory surge likely to come from any of the pandemic related forbearance, anybody, even normal delinquencies, normal things like bankruptcies happen and divorces happen. Even those folks can sell their home really quickly in a rising market. So there's no reason to stop paying or to go into foreclosure. Very, very few. So these are getting resolved out. We're getting record few. And so there's no inventory coming from this side. There is, interestingly, one area of inventory opportunity that for the agents, brokers on the call, you might really consider looking into. One of the unusual things about a super hot market is that the weird properties, the typically hard to sell ones, actually, it's a good time to sell those. I have a friend who bought a few years ago a home. The construction is called rammed earth, and they build the walls out of like mud, and it's a efficient, interesting way to build a home, but it's weird. And so it's an unusual way. And so an unusual construction can be difficult to sell. It can be difficult to get inspections, and it can be difficult to finance. But in this hot market, they were able to sell it in a few weeks and move on. So as if you were the agents and brokers in this business, thinking about how do I maybe find some inventory this year, one of the opportunities is to look around your community and find the really hard to sell properties and let your neighbors know that it's a good time to sell those. Let's look at pricing. The median price of single family home in the US this week is $369,900, ticked up this week. But the big story of the week, and one of the reasons that, the headline is that we can already see a super hot market this spring, is the light colored line here. This is the price of the new listings. Each week, new listings come to market. They get priced. The new listings hit, and that cohort has a signal for us, has all the signals of the local market, all the sellers and the listing agents. They know exactly how many bidders there are. They know how many people are in the open homes. They know how quickly the one down the street went and how much over asking the house went down the street. And so when these signals are hot, we know that we can list our home a little bit higher. And it shows up first in this light colored line here, the price of the new listings any given week. Every January, we have January 1st is the low point for the year. And then we start pricing new listings coming on January, February, March, we ramp up for the normal spring buying season. What we learned this week is that sellers they already see a ton of demand. They remembered last January was a ton. And so that this week's spike in the price of new listings jumped very big to 353,900. So while watching the steepness of this slope and how quickly it rises of the light colored line, that tells us how, as these get listed now, these are properties that will be the full market in the next month or so. They'll get offers in February, they'll close in March. So we can already see the sharp price spikes for transactions that will happen in March. And then you'll start seeing that in those headlines, the Case-Shiller and those things in April, May, June. You can already see it in the light colored line here. So super, super strong. We're going to be watching this the next few weeks. It's always fun to watch the price of the new listings. And you can see each year here that spike. And in the strong years like last year, it spiked high very quickly and kept going. And then we had a nice top for the year. So it looks to me like we're going to keep spiking here. And that's going to be really, really significant. However, if mortgage rates spike and that cools buyer demand, we're going to see, like, all of a sudden we'll know that, wow, there were no multiple offers on that last house. So now the new listings will get priced down a little bit. And this is in aggregate. And so we'll see demand changes in this number very quickly. What we see right now is that it's smoking hot. As rates rise, by the way, anybody buying in January and February already has a rate locked at the lower rate. So now the rate spikes to, say, 3.5%. People, two things may happen here. One is that folks may rush to buy this spring if they're worried about rates climbing. So what we may see is an acceleration of demand this spring, pulling demand forward. And then if rates seem like they're still climbing, but at the very least, it's a rising rate. It's going to take a month or two before you can see it in the demand, because the people who are buying now have their rates already locked at the lower rate. So it's a several months before you'll see it in the number, but you'll see it in the price of the new listings first. Here's another place where we can see the big demand this year. The percentage of homes on the market with price increases. What happens with this phenomenon is is we have investors fix and flips. You buy a home, you have a home on the market, you buy it, you put some money in, you put it back on the market at a new higher price. Sometimes it's just a pure marketing thing. Same house, you're just marketing it at a higher price in the hot market. And normally you can see we have 2 to 3% of the homes on the market have price increases. In some local markets, especially investor heavy markets like Arizona or Jacksonville, Florida, you'll see price increases are higher as a percentage. More flips, more investor transactions going. It always rises after the beginning of the year because home prices they get pulled off the market in December. They either get purchased or withdrawn, and now there's a new hot market in January, and they get priced for the new spring market. So price increases tend to rise over in the new year. We could see that in 2021, we spiked big at the beginning of the year, right? When we had our bidding wars, we had all the craziness at the beginning of last year. And then second half of the year, it cooled a bit. And as things cooled down here, they like, this was where last fall, we were looking and saying, wow, maybe we're in a more mellow environment. What we notice is it spiked big already this year. So 5.6% of the current market has had price increases recently. Back to remember our rising rates. And when I said to pay attention to what happened to the rising rates, well, with price increases, you can see here at the end of 2018, early 2019, we'd only had 2.8% because rates had spiked. Then 2 years of dropping rates, then you could see at the beginning of the pandemic, price increases spiked. Last year, they spiked big, and now they're spiking big again. So you can see just that little muted demand. Investors knew it was less of an opportunity to fix and flip in January of 2019 because it was a little more expensive. Let's flip the coin. These are the percentage of homes on the market that have had price decreases. And normally, the rule of thumb nationally is about a third of homes are overpriced. They take a price cut before they sell. Sometimes that's intentional, strategic. Sometimes it is accidental, or like a seller who's crazy or just wants to try, doesn't really want to sell it, whatever the reasons are. About a third take a price cut before they sell. You can see in January, we're reset. We get new inventory. You get brand new inventory on the market. That's not taking a price cut yet. And you get new inventory. So we're going to keep having fewer price cuts through March. And then now stuff that's been on the market for a few months gets starts to get price cuts by the end of summer, June, July. Now we're looking at school starting, and that's when our price cuts peak. So we have an annual cycle here. What we can see is so normally a third, this time of year, normally 27%. So, and this has been we've had a hot market for years. So this is actually hotter than the rule of thumb, but 27%. And then last year, all of a sudden it's 22%. This year, we're back down to 22%. Like if a third of the homes think they're overpriced, but only 22% have to take a price cut, that's because there's a lot of buyers out there. And we're on our way down again to this record low 15%. Third of homes think they're overpriced, but only 15% are taking price cuts because people are getting the outrageous prices. Here's our 2018 signal when rising rates. So what's going to happen to price reductions if rates rise this year? In 2018, you could see we started 2019 with the highest level of price reductions. It was only 29%, still actually lower than normal, but it was, you could feel it. And so in that time, if you'd overpriced and now your home doesn't sell, now you have to take the price cut. And we could feel that last fall too. If you were overpriced, demand was starting to weaken. It's turned the corner. And again, this is another signal making it look the start of the year looking remarkably strong so far. We have been watching our immediate sales tracker as a measure of demand. One of the biggest phenomenons in the last couple of years is how many properties are getting listed and taking offers and going into contract essentially immediately, sometimes within hours or just a couple of days of listing. And we'll call this immediate sales tracker. So each bar here is a week, new listings come into market. And the light colored part of the bar is how many of those are already sold before that week is up. Immediate sales. So what we see is that it's about 25% of the market. It's remarkably strong. I all year expected this to taper off. It has not tapered off at all. But one of the places we will be able to watch a change from super hot to one that's cooling, if, for example, interest rates climb and that cools demand, we'll be able to see it in the immediate sales. So we have fewer people rushing to buy at that opportunity. Buyers realize they have more opportunity. They start looking around a little bit longer. They wait to see if they can get better prices, all of those things. So the percentage, the immediate sales percentage will fall. As of right now, it's jumping. So it has not fallen yet. And it's something to pay attention to. Here's days on market. So time on market, normally in January, probably 100 days. So they get listed. Things that are still on the market now or have, got listed in the fall and they're November and December on the market. They start to sell. We start to get new inventory in January. And so our days will start to fall. Last year, we started at 70 days, which was already significantly faster than normal. And now we're down to only 56 days. This is also where I mentioned the opportunity for the weird houses. Normally the weird ones, the hard to value properties, the ones that are hard to sell or maybe need a lot of work, they end up sitting on the market longer. In an ultra hot market, those are going, and they have gone all year. So as a result, the median days is already super low. But it's our opportunity to maybe move some of that inventory there. It looks like we're going to turn around and drop down to our frenzy. Peak of our frenzy last year was 21 days. And it looks like we're going to on track for exactly that again. It's hard for me to imagine less than that, like for the whole country. We're starting with already faster than we started last year. Maybe it gets lower, but man, it's hard to imagine that it gets faster than that. That sure seems like intense frenzy. But again, so all the signals right now are ultra hot, even though we have some of the indicators like rising rates that indicate maybe it will cool. And so we're going to keep watching all these indicators to see when and if it does. By the way, I talk about these strategies. We talk about, using, for example, days on market as a communication opportunity with your buyers and sellers. So you want to go to that weird property and see if maybe it's time for them to sell. Because it can be hard to sell when the market's not this hot. We want to be able to take your Altos report to them and say, look, in your price range, the median days is 21 days, and it's the right time for you to sell this weird property if you're thinking about unloading it ever. So those kinds of things, those scripts, those ideas, the strategies are the things that we put in the Altos eBook. And we have an eBook written for agents and brokers, professionals in real estate, how to use the market data, how to understand it, how to communicate in the ways that I'm doing here to really help your clients get out of that fear, because everybody's afraid of what's happening right now. There's a link in the chat to go download that ebook. I'm going to switch to just a couple of things, and then we're going to look at our local market data and wrap up for the day. So in your Altos reports, we have at a glance measure to answering the question, how's the market? So for your buyers and sellers who say, I hear it's nuts, what do I need to know? The strategy is you say, are you a big geek or a little geek? Because if you're a big geek, I'm going to give you this report. I'm going to give you two every week while we have your house listed or while you're shopping, and we can look at all the signals. We can look at the price reductions and the days on market. We can look at all of the signals. But if you're just a little geek, that can be overwhelming. So if you're just a little geek, I want you to look at one number. This is the market action index. This works like a speedometer. The higher this goes, the tighter the inventory is and the stronger demand. If inventory starts to build, or as things like price reductions start decreasing or increasing, so we know that there's less demand in the market, you'll see the speedometer start to tick down. Right now, it's a strong seller's market for the whole country, pretty much across all price points and all geographies, like it was last year. It's ticked up from last month. It had cooled just a little bit this fall, but if you're a buyer or a seller and you are expecting the market to cool this spring, this is how you know. And even if you're just a little geek, you can take your Altos report every Monday and say, I want you to look at this one number. We can look at this, and I'll look at this in the local reports too in a sec. We can watch the market action index over time. So the light colored line here is the weekly reading, and then the dark line is the smooth trend line. Every January, we have our fewest transactions, demand drops, and then it's going to spike right back up again. So we had our first spike. Our January ended hotter than it has ever before. So we know inventory is record low. And so demand that's there keeps the market action index into strong seller's market territory, but it's already jumped back up and it's likely to keep spiking over the next few months. Again, if we see that the market is cooling, you can see it in the market action index. So all of these places are places for you to be opportunities for you to communicate with your clients. And then one other comment about how we look at the data at Altos. We look at every market in the country in price range segments, 4 price range segments. The high end of the market may be behaving very differently from the low end. We may see, for example, that the high end, and we saw this a little bit last fall, the high end of the market, in this case in the US, the top 25% of the market is 950. It's about $1 million price range. And at 84 days, so you can see the rightmost column there, 84 days, but the 300,000 is the hottest demand part of the market, and it's 49 days and falling. So this is where we'll see our opportunity. These are, in general, across the country, it's 3-bedroom, 2-bath homes that are on a 1/4 acre lot, and they're priced about 300 grand. And that's where the peak demand is. The lowest price segment often has some real junk in there, some real old or real out of maintenance properties. And so it can take longer, and you can see a little bit longer days on market right now. And this happens in a lot of markets, investor-oriented markets that have some old construction, some old stock there. We were looking at like Cleveland and Cincinnati the other day with some colleagues, and you can see the oldest stuff is like $100,000. It's 90 years old, and it took twice as long to sell as the next range up. But this is how we communicate with, we may see rates rise and we may see the market slow at the high end, but during the summer, your buyers are saying, well, I know that the market's slowing, and you say, yes, but you're buying at 300 grand. Like your stage of the market is as hot as it has ever been. And that's what we use the quartiles for. We can also use the quartiles for that investor analysis. So I can buy that $300,000 home, and if I can expand and add square footage, add beds and bathrooms, I can move up to the next price segment, and I can move from 300 to 450 with that improvement. It's difficult to go from the low end because the low end's 10,000, like smaller lot. It's difficult to invest in that move up, but that's a good opportunity, a good conversation for people who are investors or thinking about their property with that in mind. Okay, let's switch to some local market reports. Let's start with, let's look at Jacksonville. So I have a few reports here that are investor markets that have had high inbound immigration. There's a lot of both pandemic and natural migration things going on, a lot of price appreciation. So I'm starting with Jacksonville today. Jacksonville is the market action is at 63. That's a strong seller's market. This is the whole metro region, by the way. We have the chart here that I have pulled up are the price decreases. So we talked about percentage of homes on the market that have taken a price cut. And in Jacksonville, because we have a lot of investor properties, the normal range for Jacksonville is about 40% of the market takes price cut. Then 2 years ago, the market started heating up. It's down to 34. Last year, down to 24. So normally it's 40. Last year, it's 24. We bottom down here at 19%. Super hot last June. It cooled a little bit this fall. And all of a sudden, boom, this says inventory is super tight. Everything's going as quickly as it can hit the market. And we're about to hit our record low in price decreases here, meaning that those buyers are ready to gobble up everything we can. This is where we will see changes if rates impact that demand. So really fascinating in that Jacksonville went from a little bit cooler this fall to, oh, it's one of these markets that really makes it look super strong. You can see in the price range segments, here's our 339 in Jacksonville. You can see our demand here is at 28 days at the high end in Jacksonville. It takes a little bit longer. This is still pretty fast, fast across the market. But the 28 days in that mid price range, and that's falling for the spring as well. So Jacksonville, fascinating that way. Let's look at the Phoenix market. So Phoenix is at a 70. That's super strong seller's market. Inventory is way tighter than it normally is. We can see price decreases. So price decreases in Phoenix are also normally in that 40% range. It's very common. And we're down to 25 right now. But the price increases, normally it's 3, 4, 5%. Last year, we're at 8, 9% of homes with price increases. So these are fix and flips. These are that investor opportunities. These are marketing opportunities where people are leaning into demand. And all of a sudden this spring, we've had a big spike in price increases. Now, this is because inventory is low. And demand is high. And so you can see it right there. So there's another place where that activity sure appears to be accelerating in Phoenix this spring, starting the year ultra hot. We can switch this guy here to inventory, and we can look at the just dramatic inventory changes over the last few years. We're 18,000 homes, and we're down to 4,000 single family homes active right now. So, about where we were inventory wise last year, you can see here's the little beginning of the pandemic lockdown bump. There's things slowed down there, but then we just ran in. Charlotte is another place where Charlotte has both a strong inbound migration, a lot of investor activity, a lot of like iBuyer activity. So there's a lot of things like fix and flips, and as well as multiple years of strong price increases. I have the inventory chart up here for Charlotte as well, and you can see that normally this 5,000 range, and we're down to 1,500. In Charlotte, we even have fewer than we started last year with. So that's feeling even more intense on that side. We can see price increases are up, price decreases are already down to 20% there. Days on market has turned the corner and starting to fall for the spring. It's, like I said, pretty much across the country, we're seeing an accelerating early January, and like it's going to be really fascinating to see how long that persists. Then Boise had a bunch of inbound California migration last year. A lot of out-of-state buyers, LA buyers able to pay LA prices in Boise and had big price increases during the year. We could see inventory changes in Boise. This is, I think, city of Boise. So we have, 500, we watched it fall last spring. It dropped down to just 80, 90. And then this fall, it started to normalize a little bit. And I was thinking in the fall, we had maybe some cooling of that LA, California demand in Boise, meaning that Zoom town, the people who are like, I'm going to go work remote and live in Boise, I can go pay. And it looked like it was cooling. And we could see that happening in the price reduction. So here's percent of properties with price decreases. Normally Boise is in this 30 to 40% range. And then last year, 11, 5, right? It's just massive demand. Then it cooled again and we got back in the 40% range. So if you were overpriced in Boise last fall, you then had to take a cut. It's starting to come down and it's going to be fascinating to see how far this comes down. But what this says is that like the California to Boise purchase flow seems to have backed off a little bit. And it's going to be fascinating to see if it picks up, which is different from the migration to Charlotte and Jacksonville, for example, which does not look like that's a more consistent, less pandemic related migration. It's going to be really fascinating to watch Boise this year. But it's showing hot, but not quite as hot as last year. Okay, so those are the local markets. I get to this point in the conversation, and there is a lot of people are asking, like, "Hey, can we look at my local market?" And the answer is yes, we can look at your local market. Just go to altosresearch.com and book time with our team. We will look at your local market. We'll look at the data for your local market. We'll help you frame that conversation with your buyers and sellers for this spring. People are afraid. People are worried about inflation. They're worried about interest rates changing. Have I missed the peak? Is it about to crater? All of these questions are what are on people's mind, those fears, and that's what we solve with the data. So go to altosresearch.com, book time with our team, get the data for your local market. Remember that everyone in the country is watching the real estate market right now, all your buyers and sellers, all your potentials. And so this is your opportunity to communicate, to establish your expertise, and to have that in their hands every week. Okay, that's all the time we have for today. Thank you so much. We'll stick around and finish up any questions that are in the chat, and I will see you all next week. Don't forget to go look for the Altos Research podcast, top of mind podcast on your podcast channels, as well as our YouTube channel, where I'm interviewing some really good thinkers, leaders, interesting people to get like personal perspective on what's happening in the market today. Thanks, everyone.